Is Tesla's future in China at risk? The shocking impact of new tariffs on Elon Musk's EV empire. Tesla now faces one of the most critical moments in its history as it struggles to navigate a rapidly changing global economic landscape. With China's retaliatory tariffs targeting American electric vehicles, the stakes have never been higher for the world's leading EV manufacturer. These tariffs don't just affect Tesla's business in China, they represent a much larger economic conflict between the US and China, which is reshaping entire industries. Once seen as the undisputed leader of the electric vehicle revolution, Tesla is now fighting to protect its presence in the world's largest car market. The company's ability to adapt to the shifting geopolitical landscape will determine whether it continues to thrive or sees its dominance eroded by emerging competitors. One of the most immediate consequences of China's new tariffs is the sharp rise in Tesla's vehicle prices. Luxury electric vehicles, such as the Model S and Model X, have long been considered premium purchases. However, the additional costs imposed by the tariffs could make them far less appealing to Chinese consumers. In a country where affordability is a key factor for car buyers and competition is fiercer than ever, Tesla risks losing market share to local manufacturers who are not affected by these tariffs. Companies like BYD, NIO, and XPeng have already been making significant gains in China, offering high-tech electric vehicles at lower price points. With government subsidies giving them an added advantage, these domestic manufacturers are now in a prime position to undercut Tesla. The rapid shift in consumer preferences is another factor threatening Tesla's dominance. For years, owning a Tesla in China symbolized cutting-edge technology and prestige. But with rising nationalist sentiments and an increasing focus on supporting domestic industries, Tesla vehicles could start being viewed as expensive foreign imports rather than must-have status symbols. If Chinese consumers turn to homegrown alternatives that offer similar, if not superior, technology at a more affordable price, Tesla's position in the market could weaken significantly. The combination of higher prices and shifting consumer attitudes creates a dangerous scenario where Tesla could lose its competitive edge in one of its most important regions. Tesla's response to these tariffs presents a difficult dilemma. The company could choose to absorb the additional costs, but this would come at the expense of profitability. With rising raw material prices and slowing demand in some regions, Tesla is already facing financial pressure. Taking on further losses in China could strain its resources even more. On the other hand, passing the cost on to consumers by raising vehicle prices could alienate potential buyers, who may be unwilling to pay inflated prices when cheaper alternatives are readily available. Both options come with significant risks, leaving Tesla's leadership with difficult decisions to make in the coming months. Adding to Tesla's challenges is its heavy reliance on China for manufacturing and supply chain operations. The company's Shanghai Gigafactory has played a crucial role in Tesla's global production strategy, allowing it to meet demand worldwide while avoiding high import taxes. However, the latest trade tensions highlight how fragile this supply chain truly is. The EV industry depends on key materials like lithium, cobalt, and nickel, many of which are sourced from China or its allies. If the Chinese government imposes further restrictions on these materials or raises export tariffs, Tesla and other automakers could face severe supply shortages. This would push up production costs and make it even harder for Tesla to compete, especially if it has to pass those increased costs on to consumers. The long-term uncertainty surrounding these tariffs could also impact Tesla's future expansion plans in China. Tesla has invested heavily in the Chinese market, seeing it as essential to its global growth. The Shanghai factory, for example, was a game-changer that allowed the company to manufacture vehicles locally and reduce costs. However, with trade tensions escalating, Tesla may start to view China as an increasingly risky environment for investment. If the company determines that the market is becoming too unpredictable, it might redirect investments to other regions with more stable trade policies. But shifting production to countries like India or Southeast Asia would require a massive financial investment, as well as time to develop new supply chains and manufacturing facilities. This transition would not only be expensive but could also disrupt Tesla's established relationships with suppliers and customers in China, further complicating the situation. The broader global automotive industry is watching Tesla's predicament closely. Other major automakers, such as Ford, General Motors, and Volkswagen, are also deeply invested in China and could face similar challenges if trade barriers continue to rise. The outcome of this conflict will likely influence how global car manufacturers approach their operations in China moving forward. Many companies may seek to reduce their reliance on the Chinese market by diversifying supply chains and expanding into other emerging markets where trade relations are more stable. Beyond the immediate financial impact, these tariffs are shaping the future of the electric vehicle industry as a whole. With Tesla struggling to maintain its foothold in China, domestic EV manufacturers are capitalizing on the opportunity to strengthen their position. Chinese automakers already benefit from lower production costs and strong government support, giving them an advantage over Tesla. If these companies continue to gain momentum, they could surpass Tesla not just in China but on the global stage. What was once a market dominated by Tesla's innovation and technological leadership could soon see Chinese brands emerging as the new industry leaders. Elon Musk's ability to navigate this crisis will be a defining moment for Tesla. Throughout his career, Musk has made a name for himself by taking bold risks and making quick decisions. But this situation demands more than just agility, it requires long-term strategic planning. Tesla must find a way to diversify its supply chain, negotiate favorable trade terms, or even consider relocating key parts of its manufacturing operations. How Musk and his team respond to these challenges will determine whether Tesla emerges stronger or is forced to retreat from what was once considered a cornerstone of its global success. Ultimately, the future of Tesla in China, and its continued dominance in the EV market, depends on how well it adapts to these shifting economic and political conditions. The trade war between the US and China is far from over, and the global automotive industry will continue to feel its ripple effects. Tesla's next moves will not only impact its own survival but could also reshape the trajectory of the electric vehicle revolution. As the situation unfolds, investors, consumers, and industry experts alike are asking, can Tesla maintain its competitive edge in China, or will it be overtaken by domestic rivals? More importantly, can it continue to thrive in a global market increasingly influenced by geopolitical forces beyond its control? The answers to these questions could determine not just Tesla's fate, but the future of the EV industry as a whole.